again today with CAPMAR's Gaining Through Training. Today we're going to have Doug Delaney from South Carolina, an attorney, speak to us. And we're going to talk specifically today about a tax relief and structured purchase. For those of you listening on the podcast, you might want to go to the CAPMAR website and download the two graphs that we're going to talk about today. For those of you who are watching, you'll see the graphs, but you might want to download the graph to go over it. Also, there'll be 3 illustrations. There'll be a sales illustration on a life annuity and a deferred, a single life product and a joint life product. And then finally, we're going to talk a little bit about donation to a charity. So Doug, let's bring us up to date, man.
All right, thanks for having me. Hey,
tell us a little about yourself.
Yeah, I'm a tax attorney. I've been doing wealth planning and estate planning, and I was previously a CPA. So you bring a lot to planning for individuals whenever you're dealing with different tax environments, which we're going to talk about today, a few different ones, as well as restructuring balance sheet to accommodate cash flow. So we have a problem today, which we'll just jump right into it. We have a highly appreciated asset. In this case, we're going to just call it a stock, where we have almost $2 million of built-in gain. You'll see in the red on the left of the screen there, the diagram. That's kind of our problem. You know, it's a good problem to have to some degree, because in this case we've got 36,000 shares. That's typo there. That should be 36,000 shares at a current value of 80. It was purchased at 25, so we're looking at a pretty sizable amount of built-in gain at $55 per stock. Or, as indicated at the bottom there, almost $2 million of built-in gain, 1.98, which exposes that taxpayer to a 25% effective tax rate and a low yield and incredible amount of volatility risk. That's really what almost drives this particular client, and many clients will start seeing, wow, I've got this volatility risk. I don't know what to do. I've got a 25% effective tax rate. That's too much for me to handle, but maybe if we got it under 10%, or maybe if we can ameliorate that somehow, gosh, I might sell this and be able to sleep again at night. So a volatility risk and a built-in tax problem is what we're going to solve today, and we're going to do it through at least one new entity that you may not be familiar with, and it's called a pooled income fund. Now, many people have heard about charitable remainder trusts. You've heard that pitch for many years. A pooled income fund has been out for just about as long as charitable remainder trust. I'm going to mention, maybe for tax people out there, tax code is 642, and the regulations underneath it talk about pooled income funds. And the beauty of the pooled income fund, comparing it to maybe a charitable remainder trust, you know, which we would utilize to do wealth replacement. You're familiar with those types of plans. A pooled income fund, and maybe we can switch over just briefly to the other diagram. Pooled income fund, in this case, what we're going to do is we're going to structure partial donation to a pooled income fund, and then the other is going to be a straight sale with a restructure, a purchase of various product. So on the tax release, the pooled income fund at $1 million gift, they're going to realize no capital gains, obviously, because it's going to be within a charitable vehicle. This is a tax-deferred, tax-free vehicle that generates a very sizable income tax deduction that I'll get to in a second. But the big thing is that it's going to generate, in this case, $50,000 estimated cash flow to mom and dad, 2 donors, 72 and 71, for the rest of their life. So at roughly $50,000 a year, the present value of that would be somewhere around $680,000. So for the gift, the client has received back about $680,000. Okay? The donation is going to generate, and this is really breathtaking, because I tell you, compare it to a charitable remainder trust where you might see a charitable deduction of, let's say, $100,000, maybe $150,000. At the bottom of the screen, you're going to see that the deduction is $813,000 $710. Now the beauty of that is really brought home by the fact that with the charitable remainder trust, I said the deduction, let's say it's $100,000 for a charitable remainder trust, and it's $813,000 for this pooled income fund, which we know we're getting back about $680,000 worth of cash flow and yield. Okay, that's a very big motivator for this client, is yield. The $813,000 income tax deduction, we're going to use $660 of that in a second, you're going to see. And we're going to still have a carryover, a charitable carryover in excess of $100,000 at the end of the day, year one. Okay? But it's going to be limited to 50% of AGI instead of the 30% that a charitable remainder trust generates. So it's a great tax vehicle. We shift back to the other chart there. And importantly, it requires no drafting cost. Pooled income funds are already out there, so we're not having to ask client to pay $2,500, $3,000 in drafting fees to a lawyer to help draft on a charitable remainder trust. This behaves in many ways kind of like a charitable remainder trust, but it's trusteed by institutional trustees. So they just get a check in the mail quarterly, they the taxpayer. Sometimes called a mutual fund CRT. That's what it's sometimes referred to as. Okay, so you see on the left-hand side, we have this tax release that generates an $813,000 charitable deduction. The cash yield at $50,000 a year. Upon date of death of mom and dad, $1 million is going to a donor advised fund established by taxpayer. So while I'm focusing on the tax, always remember that there is some element of social capital here that if you structure your planning in the right way, you're going to be able to generate maximum value to taxpayer. Okay, in this case, we just talked about two simple things, really. $680,000 in current income payments, plus a current year tax reduction of somewhere around $330,000. We're now over $1 million that we gave to this pooled income fund, and just the benefits generated day one, income flow, tax deduction. But $1 million is going to charity. Okay. You see the tax sale there? That $1.88 million is going to generate a long-term capital gain of 1.32. We're going to take a current deduction of $660, and it's going to reduce our effective tax rate to 8.3%. We have a tax bill of $165 compared to the $495 that we previously had. We've been able to establish that pooled income fund and release some of the tax sale. Okay, we're going to talk about what we're going to. We would probably use some funds to establish a donor advised fund, you know, a specific title with the purpose. You know, some people might want different types of memorial funds set up in their name. Most of the time, they can be set up in client's name, and it can be the remainder beneficiary of the pooled income fund, so they can very much control the social capital that enabled them to reduce this tax to 8.3%. We're going to get back to that though. We're going to generate a cash flow that's going to contemplate a $700,000 annuity. Typically, we're going to get a 10% bump on that in the beginning. We're going to utilize a portion for a $500,000 gift to, it's an ILIT, but it's what I call a SLAT, is a Spousal Lifetime Access Trust. It's irrevocable. It's a grantor trust, so all the income flows through to the parent's tax return. It's easily accessible by, in this case, wife. Husband will set it up. He's the one who owns it, so you always want to do this single life policy that's going to be in there. There's going to be a gift of $500,000 to a bank account in there, and then or some investment account, and then the premiums are just going to come directly out of that. Spouse can access both income and principal. It's got a very low effective tax rate because you're not taxing it to a trust, you're taxing it to the grantor. Okay, so that tends to generate a good result. Grantor trusts are very favorable environments to do that. So we're going to have a $500,000 gift to an account for that. That's going to service this single life policy. We're going to also have a joint policy in there because, again, we're trying to wealth replace. Okay, not just the tax from the beginning, but we want to structure this so that we have different tax environments. We have this pooled income fund is a tax-exempt environment. The deferred annuity is a tax-deferred environment. It comes with obviously a lot of great qualities for time value of money and return guarantees. We're going to utilize a tax-free environment in the insurance policy, and the interplay of all those is going to generate a return of wealth. For example, that we talked about $165,000 tax. Just the annuity 10% of $70,000 would reduce that effective value from 165 to 95. So we're ratcheting that down, okay? In this case, the client is going to be happy with just getting the effective tax rate south of 10%. Wow, that's a boon. Most people are okay with paying less than 10%. That would usually overcome objections. But in this case, we've also been able to generate $415,000 in cash flow that I just call lifestyle. I mean, it's for their consumption needs. They can either keep it, and invest it, or they can use it to spend on, a new boat or a new ring for mom. So we're going to reduce. The effect of this is this plan is going to be we're going to reduce the volatility. They're going to be structured in guaranteed environments. They're going to be structured in a way where it's cash now. We're going to reduce the effective tax rate. We're going to reduce the actual tax by 66% while maximizing the yield. Okay, and maximizing, importantly, what goes to charity. I don't talk about too much about the charity because I'm focused on the tax. I'm a tax attorney, so I'm going to look at tax first. At great presumption. Because there's a lot of people out there who are more than happy to make a big gift to charity if it could be utilized, if the tax-exempt environments or tax-deferred environments can be utilized to make them whole on it. So at the end of the day, if the tax rate can be reduced substantially and it still involves a big gift to charity, there's many people who are more than happy to do that. So this is this is a good brief introduction to pooled income funds and a structured purchase. And these tend to be ratios where you'll find more of a bet to live approach and a bet to die approach through product, and it has worked out quite well. We do a fair amount in South Carolina, and if there's any questions, I'm more than happy to go over. You guys have any questions? Anybody? No. I mean, we've got gift. We got a gift to an ILIT there. So, I mean, we're limited by the unified credit, which I tend to say use it now. We're well over $5 million in gift. I like structuring slats to max the funding to the trust because it allows taxpayer to, in their mind, always be able to go, that's wealth transfer money, whether it's in a cash account or whether it's in that policy. Okay, so it serves as a funding vehicle within it, and it really, it doesn't just accelerate the gift, it freezes that value. So so as far as limitations, that's really the main limitation is the availability of unified credit, which most people have. All right, that's all I have for today.
Doug, thank you for joining us. You're here, guys. Any questions, send us an email. If you see anything, Aaron will be working on the illustrations to show you. So just to recap this, Doug, just to ask a quick question. So if the person has a financial planner or a RIA, he could have took that $415,000 and put it in there, correct?
Yeah.
And then he would be getting income off of about $700,000 off that annuity, correct?
Yep. As well as the pooled income fund.
Plus the full pooled income fund. So, and when we look at on the $700,000, what would you guess that would be? Somewhere So maybe 3,500 the rest of your month, and then 4,000. So we're talking about a swing of $100,000. Plus, we had a wealth replacement trust over here to actually do those type of programs to help them. So thank you for joining us. And those that have watched us live, you know, be sure to log into the website so you can actually see this and download these presentations. And we'll have the presentations uploaded on the website also that Aaron runs, and we'll have those in explanation form so you can see exactly how they work. Thank you, and God bless.
Thanks.